Let's get more on the markets now. David Doyle is a North American economist and Canadian market strategist with Macquarie Group, and he joins us here in studio. Talk a little bit more about both the Canadian economy and the Canadian stock market. David, we've said it many times, record territory for the TSX this week and a move of more than 15.5% this year. What's been your take on the rally?
Well, I think it's interesting when you look at what have been the strongest performing sectors in the TSX this year. They've tended to be the sectors that have more leverage to global activity rather than domestic economy activity. So it's been technology, the technology sector, which gets, I think, close to 90% of its revenue from outside the country. The energy sector has been quite strong, I think, partially due to the strength in oil prices. And then you've also seen Lifecos do pretty well. Again, a sector that has disproportionate exposure to activity abroad rather than activity in the domestic economy.
So after those groups have rallied, and the ones, I guess, that have lagged, I mean, outside of Lifecos, financials as a group have trailed energy, they've trailed technology, they've certainly trailed cannabis stocks. And there is this storyline, whether it's the Bank of Canada yesterday or skeptical bank investors who are talking about worries for the domestic economy impacting some of those Canadian banks.
Yeah, I think these are really structural issues, right? I mean, residential investment is quite elevated as a share of GDP. You have elevated consumer debt, actually very elevated corporate debt in this country as well. And when you see those sort of structural issues, it's hard to come up with a strong earnings growth profile for the banks going forward. And even if you have a low earnings growth profile, there's probably downside risks to that. And so it's hard to come up with an upside scenario for investing in a sector like that, especially when there's other opportunities in the market.
Okay, but we did tease ahead of your segment that you're still relatively optimistic on the Canadian economy. Let's show that graph again, guys, just so we can give a little bit of a sense. So the kinds of areas that you would avoid would be the banks, the telcos, the REITs and consumer stocks. Is that fair to say?
Yeah, so we're actually relatively pessimistic on the Canadian economy, optimistic on the global economy and the U.S. economy. So that informs our strategy. So those sectors you see up there are the ones that we would be avoiding. They have disproportionate exposure to the economy in Canada, particularly the Canadian consumer and the Canadian housing markets, which we see as structurally challenged. Where we'd be emphasizing more within the Canadian market are those sectors that have more leverage to global activity, particularly the tech sector and the energy sector.
So sectors that have had great runs, stick with them.
We think that works.
Don't say, oh, tech's up 30%, energy's up 20%.
Yeah, I would sort of keep your winners, right? And I would stick with that strategy for coming quarters. I don't think there's any reason to change that from here. The domestic economy is challenged. That should remain the case for the foreseeable future. There's no reason, we think, to be kind of looking at those sort of underperforming sectors and rotating into them at this stage.
So if we're going to try to do a scorecard on the Canadian economy, busy week, Bank of Canada, obviously keeping rates where they are, moving away from the bias towards interest rates, and Stephen Poloz handling a lot of questions from the press yesterday. Anne McCreath came on earlier. He was quite skeptical in those longer-term forecasts, like the Canadian economy getting back towards 2% growth, call it 2021. So he's a skeptical investor on that. How do you feel about the ability for the Canadian economy to find a way to rebound latter part of this year into, let's say, 2020, 2021?
Yeah, so I think what you're seeing is like the story over 2018 was that you had a very sharp slowdown, right? So private sector activity slowed from over 4% in 2017 in terms of its growth rate to about 1% in 2018. And I think what you're going to see going forward is that we don't really rebound all that much from that growth level. We stay, call it around 1, maybe 1.1, 1.2% going forward. There might be sort of oscillations within that band, but overall you're looking at a very low growth economy. What's interesting about what the Bank of Canada did yesterday is that they strongly reduced their growth forecast for 2019, which I thought that was appropriate. It's now, I think, increasingly challenged for the data to surprise their forecast on the downside. Where I do see downside risks to their forecast is more so in 2020. And in 2020, they're calling for 2.2% growth or so. That, to me, is much too optimistic. I'm a full percentage point below that in my growth forecast. And there's two things that I'd sort of emphasize to the viewers on that front. First is that in the first quarter of 2020, people that are renewing their 5-year fixed rate mortgages, they're the same people that took out those mortgages when the Bank of Canada cut rates in the first quarter of 2015. So you actually have a very significant rate reset headwind that comes back in 2020 and persists through 2021. And it's just a function of the fact that rates were very, very low over the 2015 and 2016 periods. The second point I emphasize is that Canada's actually had, despite our low growth over the last few years, we've had a very strong tailwind from a very robust U.S. economy. The U.S. economy, we still have strong, solid growth ahead, but it is likely to slow from here. And so that the magnitude of that tailwind from the U.S. is likely to diminish. And I think those two reasons are reasons to anticipate slower activity than what the Bank of Canada is forecasting, and potentially significantly slower activity than they're forecasting.
And just to confirm for that idea of resetting your mortgage or going back, it was in 2017 when they started raising rates. And so even though they've been on hold for 4 straight decisions, we saw 5 rate hikes basically, which means that your rates are higher than they were if you were.
Yeah, so the way we're looking at it is really the 5-year change in the Government of Canada 5-year yield. We see that as a barometer for where mortgage rates will be resetting. According to our math, even if the 5-year yield stays around where it is today, 1.5, 1.6%, you're still looking at about an 80 basis point headwind for people renewing their mortgages in 2020.
Given what you're saying, I would love to know where you think rates are going. Do you think there is a possibility that rates are going to go down?
Yeah, so I think for 2019, to me, it's fairly clear that they're probably on hold for the foreseeable future, for at least through the end of this year. Why is that? It's just because they've really pushed down their growth forecast, which again is going to make it hard for the data to surprise them on the downside. I see greater chance of easier policy as we move into 2020, and it's for those reasons I cited. There's a much greater reason, or much greater probability on that time horizon that growth data will disappoint relative to their forecast.
All right, but at the end of the day, even with those concerns about the Canadian economy, you still think energy stocks, some of the industrials, some of the technology stocks in Canada could do well because of the global story?
Yeah, because I think the global story continues to get a little bit better from here.
Okay. Absolutely. Always good to get your perspective, David. Thanks very much.
Thanks for having me.